Well, good afternoon. It's a pleasure to be with you today, even if it's just through a little screen. I look out of my window here in Omaha, and it's a pretty normal day. The sun is shining, people are going to work, and life is being lived in the usual steady ways. There's a rhythm to it that most of the headlines do not capture. Now, if you flip on the television or scroll your phone, you would think the world had tilted on its axis. You see words in big type: inflation, rates rising, recession, crisis, and the message is always urgent. Someone wants you to feel afraid, to act now, to run for shelter. Let me tell you something I've learned in a long time of looking at businesses and at human nature. Most of what makes your stomach churn when you read those headlines is not just mistaken, it is the wrong reaction for someone who wants to build a sensible long-term financial life. The real danger isn't a recession itself. The real danger is how you react to the fear of a recession, reacting without thought, following the crowd, selling when others sell and buying when others buy. That's what destroys returns. It isn't the market falling or the economy slowing, it's panic and impatience. Now, people often say to me, Warren, what's the right posture to have with markets like this? Should I be nimble, defensive? And I tell them the same thing I tell myself: temperament matters far more than IQ. You can be brilliant and still lose a lot of money if you act the wrong way. I think of temperament as a muscle. You can strengthen it, you can train it, and you can keep it from being hijacked by the headline of the hour. To help explain this, I go back to a friend of mine and teacher, Ben Graham, who invented Mr. Market. Mr. Market is a useful fiction. Imagine you have a partner in a business who arrives every day. Some mornings he's rosy, cheerful, telling you the business will be worth a fortune next week. Other days he's glum, convinced the sky is falling and willing to throw his shares away for a song. If you let Mr. Market's mood control your actions, you will either buy at crazy prices when he's euphoric or sell at crazy lows when he's despondent. But you don't have to play along. You can set your own valuation for the business and only trade with Mr. Market when it benefits you. That is the heart of investing. It's not timing the next headline, it's deciding what a business is worth to you and acting when there's a gap between that value and the price Mr. Market offers. Recessions make Mr. Market very gloomy. He often offers you bargains. If you're a net saver, meaning you will be buying more stocks than selling over the next decade, a lower market is a friend. It's like the price of hamburgers dropping. If you eat hamburgers for lunch for the next 20 years, you want the price to go down. You get more for your money. Now, temperament alone isn't enough. You need targets, good businesses, and you need a process to recognize them. Charlie and I talk about wonderful businesses all the time. By that, we mean companies that are able to earn consistent profits over long periods, companies that have some kind of moat around them, an economic advantage that keeps others from taking their riches away. A moat might be a brand so powerful that competitors can't unseat it. Think of the way Coca-Cola's name and product are almost a mental reflex for many people around the world. It might be a structural cost advantage, like Geico's direct model that allows lower operating costs. It might be a network effect where a product becomes more valuable the more people use it, as with certain card networks or marketplaces. When the tide is rising, everything looks smart. The weak companies float along, sometimes looking just as capable as the strong ones. But when the tide goes out, when we have a recession or a credit crunch, you see who has been swimming naked. The companies that relied on easy money or hype get exposed. The ones with durable moats keep earning and often get stronger. They can take market share, buy assets cheaply, and deepen their advantage. A recession, while painful, is therefore a clearing event that separates strong businesses from the weak. So how do you act when the economy looks threatening? First, you train your temperament. I use 3 simple mental exercises that keep me from being swept away by the crowd. They're not complicated, but they are powerful. One is the newspaper test. I imagine the market is closed for 5 years and I only get annual reports from the companies I own. I ask myself, will I be happy owning this business 5 years from now if I never see the daily price? If the answer is yes, then the daily fluctuations are irrelevant. If the answer is no, I shouldn't own it in the first place. This reframes you as an owner of businesses, not a gambler watching a ticker. It forces you to think about the quality of the enterprise, its earnings, customers, and competitive position, rather than the mood swings of Mr. Market. The second exercise is inversion. Instead of asking how to make a lot of money, ask how to make sure you lose a lot. If you would lose money by trading frequently, by following tips, by buying things you don't understand, by using leverage, by trying to predict macro events, then the solution is simply to avoid those behaviors. That trick is underused. Charlie uses it all the time. He says to think about where you are likely to fail, then avoid those paths. Avoid obvious mistakes, and you are already far ahead of most people. The third is continuous learning inside your circle of competence. You don't need to know everything, but you must know what you do know. Read annual reports. Learn how companies make money. Read biographies of people who built businesses. Keep expanding your circle slowly and honestly. The biggest mistakes I've made were when I thought I understood something I didn't. There's a temptation when markets get volatile and opportunity seems everywhere to step outside what you really know. Don't fall for that. Stay inside your circle until you expand it through honest study. Now, alongside temperament and mental tools, you need a checklist for what makes a business wonderful. There are many metrics and indicators you could use, but 3 characteristics stand out as non-negotiable in my view. First, consistent earning power. I want to see a history of profits, not speculative promises of future growth, but a track record of earning money over time in good markets, and bad past performance doesn't guarantee future results, of course, but a business that has never shown it can make money is unlikely to suddenly become a marvel because the headline says so. Second, high returns on tangible capital and low ongoing capital needs. I like businesses that generate cash and don't need a constant torrent of reinvestment to maintain their returns. Think of drilling an oil well that continues to produce year after year with little extra capital. Those are the businesses that can compound value with little reinvestment. Contrast that with a company where every year you have to keep pouring money in just to tinker and survive, a treadmill that requires endless effort to stand still. In a recession, cash is oxygen. Companies that produce it without huge capital demands can thrive. Third, pricing power. In an inflationary environment, being able to raise prices without losing customers is the greatest defense a company can have. If customers love what you make or need it badly enough that they will pay a bit more, you can protect margins and earnings. If you sell a commodity where price alone matters, you're vulnerable. Pricing power is not just nice, it's often decisive. If you combine these 3 things, consistent earnings, low capital needs with high returns and pricing power, and you can buy that business at a sensible price, you're likely to do very well over time. A recession increases the odds of getting such a business at an attractive price because Mr. Market tends to panic and misprice quality. Let me tell you about 2008 briefly, because it's instructive. We didn't have a crystal ball then. Nobody did. But markets plunged and prices were slashed across the board. People were panicking, calling each other and asking what to do. Charlie and I looked at the fundamentals. Did these businesses have strong economics? Could they continue to earn money? Could they survive a tough environment? For many, The answer was yes. We were able to buy pieces of great businesses at prices we hadn't seen in years. That period turned out to be one of the most productive times for long-term investors who had the temperament to act. Now, I know it's easy to say be greedy when others are fearful and harder to do it when your retirement account is down 30% and every voice you hear says to bail. That's why the mental exercises are crucial. They make the abstract advice operational. Beyond business selection, there is another investment that trumps all: investing in yourself. People ask me all the time what the best investment is. They expect a stock tip. I tell them the best investment is your own ability. A recession can shrink portfolios and devalue cash, but your capacity to earn, your skills, your judgment, your health, your relationships, those can't be taken away. When you invest in yourself, you increase your earning power and resilience. Employers and customers will pay more for people who are better at what they do. Investing in yourself could be as concrete as learning a new skill that makes you more valuable in your job, or as wide as improving your communication and reputation. It could be learning a trade, getting better at sales, studying a field deeply, or simply taking care of your health so you are fit and energetic. The return on that investment compounds in an astonishing way because as your earnings grow, you have more capital to invest in compounders, the wonderful businesses we discussed earlier. So how do you put this all into a practical plan? If you take away just a few actions from our time together, here's a straightforward three-part approach you can start this week. First, turn down the noise. You will do better if you disengage from the hourly panic. I don't mean you should never read the news. Information is useful, but you must control how much of it you let influence your emotions and immediate actions. Avoid checking your portfolio every 5 minutes. If you own good businesses, daily price noise will not change the underlying economics. Second, prepare a watch list of wonderful businesses. Don't rush to buy. Pick a small number. 5 companies is a fine place to start and learn everything you can about them. Read their last 5 annual reports. Understand how they make money, who their customers are, and what could threaten them. When the market offers one of these companies at a price that makes sense, you'll be ready to act with confidence. Preparation replaces panic. Third, invest in yourself. Identify one skill or capability that, if improved, would make you more valuable in your career or business. Take a course, read the right books, find a mentor, or just set aside an hour a day for focused improvement. This is not a fluff suggestion. It is the most reliable path to increasing your financial resilience. I also want to remind you of a few practical cautions. Don't overuse leverage. Debt magnifies mistakes as well as gains. Don't believe anyone who claims they can time the market or predict specific short-term moves with confidence. And don't trade frequently. Fees, taxes, and mistakes will erode returns. Be honest about what you know and what you don't know. When a story sounds too good to be true, it usually is. There's also something I find comforting and useful to think about: the long arc of this country and its businesses. Over 2 centuries, there have been wars, depressions, panics, and pandemics, and yet the underlying productive power, the tailwind of a society that encourages innovation and rewards those who provide value, has been strong. Never bet against America, and certainly never bet against the ability of people to solve problems and create wealth. That doesn't mean every company will do well, but the landscape of opportunity endures. Now you might be wondering about dividends, bonds, and cash. Cash is useful as a tool, insurance in an emergency, and optional dry powder to take opportunities when they come. But hoarding cash because you're afraid is generally a poor strategy because it lowers your ownership in productive assets. Bonds have a place for those who need stability and income, but the long-term compounding power of owning businesses that earn more and reinvest their profits is hard to beat. The specific allocation depends on your goals, time horizon, and temperament. The key is to know why you're holding each asset and to avoid being tossed by headlines. Before I finish, let me repeat the 3 business traits I think matter most: demonstrated consistent earning power, high returns with limited capital reinvestment needs, and durable pricing power. Find businesses with those characteristics, buy them when you can at sensible prices, and hold them patiently. Use the newspaper test, invert the problem to avoid obvious mistakes, and keep learning within your circle of competence. And above all, invest in yourself, your skills, your health, your reputation. If you do those things, recessions become opportunities rather than threats. Mr. Market will sometimes be your best friend, offering you bargains because he's gloomy and irrational. When that happens, don't be afraid to act, but act with preparation, not panic. So my final piece of advice: live a bit of a different game. Don't play to win the quick headline. Play the long, steady, sensible game. Build your own moat through competence and discipline. Invest in businesses you understand. Invest in the one asset that you control completely, yourself. If you do that, you'll find the headlines have less power over you and your life will be guided by sensible decisions rather than fear. Thank you for spending this time with me. I hope you'll take away a little of the temperament and a few of the tools we've talked about.